Good evening and welcome to this edition of Rush Hour here on ET Now. I'm Vikram Oza and we dive straight into American inflation even as we watch its impact on Wall Street. So this is the story of inflation in the US right now, where consumer inflation has indeed slowed for the month of June, coming in at 3%, which means it's marking its smallest annual increase in a span of more than 2 years, continuing to cool down. And this cool down has been supported by the rise in gas prices as well as rentals. Those have gone up in the country. The real question now stays, is it enough for the Fed to continue its rate hike pause, or will the Fed continue to stay hawkish? Let's try and answer these questions. For that, Nadia Elbilassy, Market Analyst at Equiti Group, joining us. Great to have you back on the show with us. Nadia, do tell us, looking at the kind of numbers on the CPI front as well as core inflation, which the Fed looks at, do tell us how important it is, the kind of levels that are getting marked right now, and how this is going to tell on market reaction.
Hi, Vikram. Thanks for having me. Yes, inflation numbers just came out. They came in at 3%, marginally lower from last time, which was 4%. And core inflation was 0.2%. Also, the CPI came in lower than expected, which is a really good sign, especially after the NFP numbers that we saw from last week. So now we have NFP numbers that are at 209,000 jobs, less than expected. And we also have lower inflation figures. So the two coherently work hand in hand to affect the Fed's decision. However, markets had priced in by 92% according to CME that we're going to see a 25 basis rate hike this month. However, now things can change for the coming months of September and the last quarter of the year.
So now if the Fed is going to move as far as interest rates are concerned, because the jobs market continues to be a rather sticky proposition. On the other side, you find inflation cooling down. So both of these concerns before the Fed, as far as rate hikes are concerned, how do you think they're going to move next? And how do you think the markets are going to react to the Fed's next move?
So I think already ahead of CPI data being released, we've seen a rally in the stock market since yesterday, and before yesterday, Wall Street was on a good note. And also due to China's new financial support policies, Asian equities were also doing well. So we are seeing, and because of the dollar's downfall and expectations of the end of the tightening cycle, we're seeing other major currencies like the sterling or the euro or also gold prices, they're doing relatively well because of the dollar's downfall. So I think market's reaction overall is well priced in to see that the end of the tightening cycle is very near. We are expecting a rate hike this month, and Fed officials that say don't only look at one statistic for the labor market. I mean, they all matter. So I think most likely we're going to see a rate hike this month. However, things may very much change for the upcoming months or the last quarter of the year. So we're bound to see, but based on economic numbers, as Jeremy Powell had said, it depends on the economic numbers that we're seeing. So I think the economic numbers now support that the Fed can only raise rates by approximately 25 basis points plus another 25 basis points. And that's what's being priced in the market. And it's giving a breather for some of the assets in the market right now.
And very quickly, Nadia, these economic numbers, are they going to put added selling pressure on the US dollar?
Well, it depends, of course. So the more likely that we're going to see the labor market get weaker and that we're going to see a slowdown in the economy, like the U.S. economy, then we're going to see pressure on the dollar, yes.
Fair enough. Nadia Elbilassy, always a pleasure getting your perspective. Thank you very much for joining us on this edition of the Rush Hour.
Thanks so much for having me.